we look at what's happening politically, and it's all just one big game. It's being run in my world as I keep looking at it. These are uh, government decisions, government policy being driven by NGOs that you and I don't really know a lot about. And whether that's the World Economic Forum or the World Health Organization or whatever other world blah, blah, blah organization, none of it is our politicians making
I
this
just
policy.
had an idea. We should create our own NGO. We should call it the World Real Estate Forum. What do you think?
Let's do it. Let's do it. Anyways, okay, so that's what's going on. When we look at what's going on economically, we have to batten down the hatches. We've shared this many times, and it doesn't matter whether you're a real estate investor or not. You're going to work every day, whatever it is, you're a small business owner. There is going to be some headwinds, and this goes back to what happens in these scenarios is that we're seeing, number one, let's qualify a couple things, JG, in this what I say is a recession. For the top 30% income earners, they don't really notice it. It's inconvenient. It's annoying. They're paying attention. Maybe they're spending a little bit less, maybe complaining about it a little bit more. But that bottom 50% and then the 20% above that, they're feeling it, and they're making really tough decisions. And as a matter of fact, when we look at credit card debt that is increasing dramatically, it's not consumerism, it's actually people having to pay their bills on their credit card to see them through the month and to the next month. And so the costs that are associated with this economy in terms of the inflation and the costs are, let's face it, they're beyond the wage growth that we haven't seen. And so people are really having to figure out how to pay the bills on a month-to-month basis. And by the way, even Tiff Macklem in his narrative pointed out that, inflation is under control. Sure, now they've upped the bar. It's now 3%, blah, blah, blah. But the point is this. What's it been over the past 5 years, JG? In some cases, it's been doubling of prices. Consider some foods. Consider what's happened in terms of rent, housing, all the rest of it. Inflation has been quite dramatic. It hasn't come back down in that 5 years. So it's hit this. Now they've got it under control. But the cost of living is not coming down. It's risen. It may have flattened, but that's what people are bumping up against.
For sure. Now, Patrick, on this note, let me bring a little optimism to this very depressing conversation.
I know, okay? I'm bummed out about it too.
Which is, in this time, and I agree, I'm not saying it's easy out there, because it's not. We're slugging it out. We're doing what we got to do. But you know this, Patrick, as well, because you've been through many of these recessions, whether we're in one or just not technically in one, but kind of in one, whatever the case may be. The point is there is a ton of opportunity in these times. These are some of the best times for people to create businesses and start businesses and grow their business. And that's that's the mindset I subscribe to. I believe you create your own economy. That is something that some people have to double down on, and they got to double down on themselves. They got to double down on the people around them. And I agree. It's not easy for everybody, but for some people that are going to rise to the occasion, it's definitely possible. Some great deals out there. Some
great deals out there. Well, here's the one thing that we know for sure. The U.S. is doing what the U.S. is doing. They're about to, Trump announced $2,000 stimmy checks that he's going to be pushing out to everybody. If you don't think that's going to drive inflation, you don't remember what happened in 2020. So when the government, and by the way, Canada will create some form of quantitative easing, we will start pushing money into the economy again. So hold on. Here's my prediction. Hold on to your hats, folks, because inflation is going to get worse and through 2026, 27. Now, having said that, JG, if you're following the show, if you're part of the RAIN community, you know that our belief is that we have to get our capital, our fiat currency, into hard assets. We're big believers in real estate. We're not saying all real estate works, just throw money up against the wall. We're saying be very strategic, but hold a hard asset, real estate being one of those things. I've also expanded over the past few years, and I've shared many times, precious metals. I still think that is a good store of value, as well as, depending on your risk level or risk tolerance, own some Bitcoin. So, if you want to play in the equity market, you better be in it every single day to pay attention and understand some technicals, because that's a game that is, it's very interactive these days. It's not like set it and forget it.
There's a ton of rhetoric right now out there about a bubble. That's for sure. Lots of heat to being turned up around the AI bubble and so on and so forth. So
Is it sustainable? Yeah.
yeah, tons of that. But let's speak to real estate a little bit more, Patrick, which is student housing has, as we said in the opening headline, silently collapsed. And I've been talking about this for years, Patrick, that the student approach and the student rental business is a somewhat finicky. You got to be very careful. Yes, when it works really, really well. But I wouldn't put my entire portfolio in the student rental market. I've said this, but in fact, I've even advised clients. I've even advised clients that they should take their student rentals and convert them to duplexes, which like 2 units, which allows them to then rent to students and or rent to professionals, like have long-term renters, and maybe they can do both. That way they're diversifying their risk and they're lowering their risk profile. But man, you know what? People who do student rentals, and I'm going to go out on a limb here, Patrick, and I might piss off a couple people, but they are addicted. They are addicts. And they get such good cash flow on these properties that they're addicted to the cash flow and they cannot bring themselves to do anything else. And I've been seeing people firsthand lose their portfolio, and they are taking an ass whooping because they're not willing to change their approach. And I think it's the dumbest damn thing in the world, because student rentals are going to suffer for a while. Look at these stats, Patrick. Student permits are way down. I mean, way down. And you think you can get $900 for a room? You're dreaming. You're not getting $900 for a room. You're back to $550 or $600 or $650, and you're struggling like hell to keep students. And that's just the reality. So if you're listening to this and you're one of those addicts that's addicted to cash flow in the student rental market, I'd be very careful, because I think the Green Reaper's coming.
JG, we've been talking about this for 2 or 3 years. You've brought it up many times, but when we look at this particular chart, I mean, look at it. It's the lowest influx of students in at least 10 years, at least. And so, when you compare that to where people were really jumping on the bandwagon in 21, 22, right up through the 24, wham. I mean, we're down to what, a third of what we were bringing in before? But to their credit, I mean, we were told this is what was going to happen. And, the cost of that, aside from the real estate investors who kind of went with that strategy and really hammered it. I mean, aside from that, think about the universities that are getting hammered because they don't have that income coming in. So there's all these ripple effects of students not coming into the country. And the least of which, or no, I don't want to say the least of which, but one of the consequences of that is the universities and the breakdown of income revenue into those universities, and then of course student housing.
And I just want people to look at this graph carefully, because so the number in 2025, in 2023, it was the highest it's ever been. It was like almost 700. And then in 2024 went down to 450, and then in 2025 it's down to like 300. Now that's far from 700, but it's going to continue lower. You're going to be at 150 and 175 in 2026, 2027, 2028. So it's going to get worse before it gets better. And man, it's incredible though, Patrick, as you rightfully pointed out, I think it was in the last show, boom cycles hides a lot of mistakes. And this is one of those things, when the cycle turns in the real estate market and you hang on to your old antiquated strategy that doesn't work anymore, you're going to pay the piper. You're going to ride the wave all the way down. But here's the best part, Patrick. The best part is you don't have to. Like, some people have made the switch. They've gotten away from, let's just say you own 3 rentals and all 3 of them used to be student rentals. I'm not saying get completely out of it. I'm saying maybe take 2 of them and make them long-term rentals and keep one of them as a student rental in order to diversify your risk. And if someone's not willing to consider that as possibly a good idea in this market, well, I mean, I don't know. I don't want to say they deserve what they're getting, but I mean, shit, the opportunity's there for them to change. They're choosing not to change.
They're choosing not to change.
Moving on. Okay, let's talk Carney budget.
Well, I think that it's what do we say about the Carney budget? I mean, we're taking the deficit from 40 to 80 million, whatever that number is. They're going to pump 180 billion dollars in, our deficit from 40 to 80 billion. Like, I mean, the numbers are getting astronomical. There's no way out of it. Our interest payments alone are going to eat up a huge part of our budget. Where the heck is the money coming from to pay all of this? We're still shutting down oil and gas. We're still on this whole green initiative with lots of promises of going, outside of the U.S. in terms of developing our economy. Now he's saying Canadians buying Canada or, doing business within the country. That doesn't speak to exports. Like, it's nonsensical in so many ways. I'm trying to find. I haven't literally sat down now and looked through all aspects of the budget. I've looked at highlights of it, and of course, none of it makes sense to me because I'm capitalist, not socialist, so I don't get it. That's how I look at it, and it's very, very frustrating to watch what's going on. We we look at the rhetoric and the narrative, and if you really unpack it, there's just not a lot there. And so, what's to say about the budget? Yeah, more to come. We'll see what happens. When is it? Is it today or this week? Is there supposed to be a vote on it or something? I don't even know anymore. I've lost the plot.
The system, Patrick, the system is broken. And what I mean by that is, when you have to constantly be making these promises and in order to get reelected, like this, just the whole way the system is created, it's broken. It needs to be rebuilt. Now, I have no damn clue how they're going to do it. But what I know is I don't think this is sustainable, just like you don't think it's sustainable. And this is the only thing these politicians have, is to make promises, give money away, give more money away. And the thing that really frustrates me more than anything else, and I talk about this all the time with people who are willing to listen, is it hurts the very people they think they're helping. All of this does is hurt the very people they think it's helping, that think it's helping them, but it's not. This all gets through back to it. All drives inflation and all eats away at the middle class and the lower income classes. It just eats away at their income. Inflation goes up, their taxes go up. They bring less money home, and all of this is one big friggin' ruse, Patrick. And none of it is going to work. That the whole thing's got to be shut down and started over again. But I don't know how the hell we're going to do that.
How to look at that. So we have to always look into the future, connect the economic dots, try and make sense of it. What are we trying to do here? I mean, ultimately, we're looking into the future, and the picture's not bright. Let's face it. We're going to go through and I mean, we have our prime minister telling us we're just going to have to suck it up. We're going to feel some pain. Like, he's telling us all the things that we're going to experience, which is not, exactly driving optimism. That's for darn sure. There's so much distractions going on. Now they're talking about, conservatives crossing the floor. Like, a lot of noise out there keeping people off keeping the masses off the real issues at hand, which is what's happening economically. So those are frustrating parts of the whole, I guess, process that we're going through. Is this within this government? Carney's broke. We've shut down, as far as we know. Maybe we haven't, but it appears that we've shut down any negotiations with our biggest trading partner, being the U.S. We're now opening up the door to say, hey, let's hang out with China. Okay, well, it's not like there isn't tons of real data supporting the corruptness of China in with Canada. I mean, that's not a secret. It's like they're in front of us. So why are we going to, China when we've got neighbors that economy is huge, and we can't seem to figure out how to negotiate with them? So we're busy making Trump wrong. That's another part of the rhetoric that drives me absolutely crazy, is that if we had some talent as a prime minister and as a liberal team, we'd be in negotiations still with Trump. And we use all sorts of excuses. Well, Trump is this and Trump is that. He's heavy-handed. Got it. Well, there's a whole bunch of other countries seem to be making it work. What's wrong with Canada? So maybe there's some big announcement coming. Maybe, Carney's being all sly and he's just not telling the general public what's going on. In parallel with all this other bullshit, he's actually negotiating something with the US, but I don't think so. So those are the kind of it's really tough to be optimistic about what's coming. So when we look at that, optimism aside, JG, we have to say, well, how do we not just survive, but even thrive in this upcoming economy? And I'm planting my, the one line I've drawn in, we are on the precipice of stagflation. I've said it. Everything is pointing towards that. Short of a stock market meltdown, all indicators are we're going into a stagflationary environment. Rising costs against rising costs against rising unemployment. And that's what we're going to be facing as businesses kind of vacate, shut down, cut back, all the things that are actually in real time happening.
Now, Patrick, you have this other graph here, which is net debt to GDP. This is one of the graphs that we're going to talk about here, which I think is I don't want to say it's connected to the budget, but maybe
It
it's
is.
connected to the budget.
Yes, 100% it is. And the debt to GDP, uh, they're positioning it like we're amazing, but what they've included in that math that they've done, JG, they've included they've included our CPP and what do they call it?
QPP.
QPP, secure old age security pension plan, the pension plan. They've held that as their
Now,
asset.
did they just do it? Did they just include Canada's but not the other nations, or did they include everyone's? Like, is it at least a fair graph or no?
No, it's not. And and the numbers that they're showing, like for Canada, they've overstated that because they're including things in our asset class, if you will, that it isn't ours. It isn't the government. So it's the people's, the
But
pension
Patrick,
plan.
the source of this is the International Monetary Fund. I
Yeah.
think that's one of those NGOs you're talking about.
And on it goes, and on it goes. So I don't want to talk about it anymore. I'm tired of it. I'm tired of the rhetoric and the absolute gaslighting and lies that are happening. And I know that's being really kind of out there, but yeah, I'm just tired of it. I'm
Okay,
frustrated.
let's talk about power of sales. There's no gaslighting there. Power of sales are up. Power of sales are going up. That's why lenders are freaked out. That's why we have a liquidity crisis. I just got off the phone, Patrick, with a client that we're working with, and we're looking at building 64 coach homes in a coach. I'll call it a coach home community. It's 64 of them. It's a whole development. It's really a cool little project. And the owner came back to me yesterday and says, "Listen, how are you finding financing for land development?" I said, "It's horrible. It is not easy. It's challenging. They want a million things. You have to cross collateralize. You got to have very deep pockets, and you got to be willing to go into them. I mean, it's not a great time. Now, deals can still get done, but shit, man, they're hard work. That's for sure. And if people are asking themselves, why is it so difficult? This is why. It is freaking the lenders out. They are very, very concerned about their balance sheets, and that's what's happening, Patrick.
Well, they are, and we've talked about it several times, and I think we can't over talk about it because it continues to gain even more momentum as we start to, and as the banks start to disclose just how much bad debt they have on the books, and and then on top of real bad debt, and then let's just take a look at the wave of potential bad debt that's coming onto the books. So they're tightening up. They're having to.
They see the wave, just so everybody knows, they see the wave, the toughest of the wave, like the most kind of all the majority of the bad debt hitting the books in 2026 and into early 2027. So this kind of early spike, they're all anticipating it's going to get worse for all of 2026, which is why they're tightening up right now, which really sucks for us as real estate investors, but that's the market.
That is the market. So we have to be, just aware of that. Again, as I've said many times, this is not the time to over leverage. I'm still concerned with, some individuals and just people in general in Alberta who think that, this market, is particularly Edmonton, is going to be this way for a while. I've been saying for a year now, and I think we're probably about 12 months away before people really start to get it, is that We're going through this cycle. Edmonton has come out of their boom cycle. We're into the slump cycle, and the slump cycle is not necessarily a bad thing, JG. It's not like it's a crash and boom or crash and bust kind of scenario, but it's going to get really soft. And so people don't like to hear that, and I'm suggesting that you don't have to stop everything you're doing. Just be more mindful of it. Don't over leverage. Make sure your cash reserves are good. Make sure that you're working on your pro formas in a way that is allowing for a decrease in rents, not an increase in rents. So you have to be really conservative in your math, which means some deals that you wish would work aren't going to work. You're going to have to walk away from them, and you're going to have to be more discerning and more diligent in the math that you're doing, because in probably 12 months from now, somewhere in there, 8 to 15 months, let's say 10 to 15 months, you're going to start to see Edmonton get softer. That's it.
Well, I want to show a chart on the vacancy rates here, Patrick, because vacancy rates are back to, let's call it, more normal levels. I mean, vacancy rate through COVID went to like 1%, 1.5%, less than 2%. Some places like Peterborough was under 1%, which is crazy. I mean, and it's funny. I find it hilarious how the average person just normalizes this shit really quickly. Like, it happens for a couple months and all of a sudden this is the new norm. It's kind of crazy how people jump on board like that. But vacancy rates right now, national average is just over 4%. If you look at the various markets on your screen, and this isn't all of them, but it's some of the major markets, and this is for Q3 of 2025. And I've been talking about this for months, Patrick. It's been actually a whole year that I said it was 1 year ago that I noticed the rents were starting to soften. And it was it was $10 here, it's $15 here, it's $50 here, $50 there. And that has continued, and it has stabilized. It's not crashing, but it has stabilized, and it is taking longer to rent great places that typically would rent out much faster. And the crappy places where a landlord or a rental housing provider is not willing to put renovations in, not willing to update, not willing to bring it up to snuff, they are sitting, and they're going to continue to sit. I've been yelling this from the rooftops for months now, Patrick, where if investors want to secure their investment, they have to be willing to do renovations and provide a good place. That crappy rental by the dumpster that did really well in the hot market in the boom cycle, as you know, Patrick, it's the first one that doesn't do very well.
Totally.
Right. And I just to give you a story, there's a client, we just built a beautiful coach home for this client. Last time you were here, Patrick, we didn't get a chance to go visit, unfortunately, but this newest coach home we just built, that coach home should have rented for $2,350, $2,400, $2,450, maybe even $2,500 in a hotter market. We just rented it for $2,200. Now that's $100 less than he should have got per month. But is it the end of the world? No, it's not the end of the world. And that's the other thing, Patrick, is investors, as you said, when they do over leverage, one of the problems is when you over leverage, you give yourselves absolutely no breathing room on the downside. So that $100 and all of a sudden makes a huge difference, and you're concerned, and you're cash flow negative, and so on and so forth. And that only happens when you over leverage. If you don't over leverage, you have that breathing room. And you know what? We just rented this great place for $2,200. And you know what? The next time it comes up for rent, we'll probably rent it for, the market rent's going to be back up. We might get $2,300, $2,400, $2,500, $2,600, $2,700, depending where the market is at. My point is that when you do real estate, you're looking at being in this game for 10, 15, 20, 30, 40 years. So don't get caught up so much on like what you rented it for today, because over the course of time, this stuff will all average out.
We say it all the time. You got to have a longer term plan, knowing that you're going to go through these dips, through these cycles, and then we just have to accommodate them. That's what's going on. I can't stress enough. We have to put our money to work in this current environment. We are at the effect of what's happening global macro. That's the bottom line. JG, we've talked about it many, many times. I think I didn't include the gold chart in here, but
there's one gold chart about China, and they're just ripping gold at China. Well, I was going to ask you, that was actually the next question I was going to ask you. What's happening there?
Well, this goes back to what's happening is ultimately these other countries east is losing confidence that they don't want to they want to get out of doing business with the US. So when the US put all the sanctions on Russia, all these other countries went, holy shit, if they can do that to Russia, what can they do to us? We own all of these US dollars vis-a-vis the US treasuries. And so what they started to do was shift out of US treasuries and they started buying gold. By the way, I've said it many times, every global or every central bank globally has invested in gold. Almost everyone. One of the missing, of course, is Canada. We own no gold. You
I
have
was
no
just
gold.
about to ask because I bet you Canada's missing that boat.
No. We got rid of that in 2015, 2013, something like that. But the point is, this is an indicator, and it's why it's so important for people to understand what's happening with fiat currency in general.